Marginal tax brackets. What is that? Hey taxpayers, it's Tiffany Gonzalez CPA here, founder and CEO of Accounting to Scale. And today we're back with another great installment of What is that? Where we discuss financial term and topics you may have heard, but we make them super easy to understand. Today we're talking about marginal tax brackets, which can be a tricky subject during tax time every year when I help clients understand how much tax they're actually paying and what bracket they land in. So if you've kind of been confused about marginal tax brackets, tune in and let's get started right at the beginning. Marginal tax brackets. What is that? The modern day income tax system was actually adopted in 1913 when this country needed a way to pay for World War I. At the time, everyone was charged a 1% tax if you made more than $3,000. And if you made more than $500,000, you had an additional 6% surtax, paying a total of 7% on your income. But that grew very quickly. And by 1918, if you made over $1 million, you were paying 77% in tax. Ouch! The marginal tax rate is the rate of tax a taxpayer pays on each additional dollar they earn. In theory, the next $100 you make isn't taxed the same as the last $100 you made, where each additional portion of income that you earn is taxed more and you earn less. The idea behind the marginal tax bracket system is that higher income earners pay more in tax than lower income earners in an effort to ease the burden of lower income earners paying that much in tax, as well as a strategy in which to redistribute wealth in the country. If we had a flat tax system, such as 20%, this means whether you make $100,000 or $10,000, you would still be paying 20%. With a marginal tax bracket system or a graduated rates, a person that makes $100,000 will end up paying more in tax than a person that makes $10,000. Here are the marginal tax brackets we currently have up on the screen. Depending on whether you are single, married, filing jointly or separately, or the head of your household, you will pay a different tax rate also based on where your income falls. However, a common misconception is you might say, well, I'm a single person and I make $70,000. Therefore, I pay 22% tax. But that's just not the way the marginal tax brackets work. You see, for the first portion of your income, specifically 0 to $9,950, you'll pay approximately 10% tax. Then above that figure, $9,951, you'll pay a 12% tax up to $40,000, and so on and so forth, where your average tax bracket will be different than your marginal tax bracket. So let's go back to that marginal tax bracket. You've told me you're a single person who makes approximately $70,000 and therefore lands in the 22% tax bracket. This means that for every additional dollar you earn, think the next raise, you'll be taxed 22% until you pass $86,000 approximately of income. At that point, you'll actually be taxed 2% more on that new income. And you see, that is why the more money you make, the more tax you pay. Not just because it's a higher amount times the percentage also continues to climb. So when we talk about strategies of, should I withdraw from this 401k account now that I'm in retirement? We look at, well, how much can you withdraw without bumping you to the next marginal tax bracket? And is that money that you're going to withdraw enough to support whatever goal you have for that income? This complexity and strategy has to happen during the year. Tax planning is something that you have to proactively invest in before the year has ended, not during tax preparation season. And the good news is that I'm available to you all year long. So call our office at 305-503-2814 if you'd love a consultation. While you're at it, hit the like button and subscribe to our YouTube channel. Follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.